How you doing, friends? Today, we're continuing our series. Let me first introduce myself. I'm Coach Ernie. This is the 0 Days to Expiration podcast, YouTube live stream, whatever you want to call it. It's every Monday, Tuesday, and Wednesday morning at 9:15 a.m. Eastern Time. And I provide a presentation each one of those days, typically themed each week. So this week is going to be really about the specifics and strategies that we use here at 0DTE to make money. Or I should say, to position ourselves so that we're in the best posture or give us the best opportunity to make money. And the way we do that is we're playing 0DTE options trades using out-of-the-money butterflies. And the reason why we use out-of-the-money butterflies is so that we can get extreme asymmetry. So that means that we take very tiny little risks for large potential profit. We're looking for that convexity or convex pricing in an option. That means that we're looking for a big change in the pricing of an option or a position so that we can get the best risk to reward and best risk adjusted potential profit. And that's a big deal. And it's not something that most traders do at all. In fact, most traders do exactly the opposite. They're looking to take on just an inordinate amount of risk to make tiny profits, where we're looking to put on the least amount of money to make the largest potential profit. That's a fundamental difference in the way we approach trading. And it's worth noting. So today we're going to go over the GEX or gamma exposure and talk about gamma relative to how we trade. But before we do, we have to do the same thing that we do every morning, and we go through our routine, our pre-market routine, to figure out how we're going to set ourselves up for trades. And that involves three things. It involves looking at the VIX to determine where the VIX is. That will tell us the rate of premium decay, and that will inform us our best posture or how much we should expose ourselves to today's market and that level of premium decay. And then we're going to look at determine the market direction, get our directional bias, and then we'll look at market structure to look at where our entry events will be, so that when a trade opportunity comes along, we'll already know how big we're going to make our trades, what direction we're going in, either an out-of-the-money call or a put fly, and where that entry event is going to be. We know all of this stuff ahead of time. And so we do this every morning. Prior to the trading day, so I make it part of our routine here on this show. And what we're going to do is, first of all, take a look at TradingView. And let me get mine up here. And as I said, we look at our VIX playbook first to see what volatility regime that we're in. This isn't any big mystery. Our volatility has been dropping, although we're a little bit elevated right now compared to last week at just under 18.9. We're in the lower end of Goldilocks. I call this Goldilocks 1. So I have three volatility regimes. I have Zombieland, Goldilocks, and Chaos. I split up Goldilocks into two, Goldilocks 1 and 2. And that's more generalized so that we understand what the total situation is, what is the rate of premium decay. And from that, we choose the width of our flies, or we might even look at edge case trades, which we're going to talk about later on in this week. How we choose those edge case trades on extreme low or extreme high volatility. Anyways, what we're looking for is how wide we're going to go. And we are, like I said, in Goldilocks 1, so we're somewhere between 30 and 40 wide. I'd say that we're leaning more towards about 35 wide. So these are SPX index butterflies looking to go 35 wide. So it's a spectrum. And last week we were closer to 30 wide because there was lower volatility and increased premium decay, meaning there was less meat on the bone. Today, there's a little bit more, probably due to the events that happened over the weekend and the uncertainty going into this week. So things have risen a little bit in terms of the fever in the market. So we go a little bit wider. We literally walk into the fire. This is it's worth noting too, this is an anti-fragile strategy. That means that our strategy gains with the more stress or more volatility there is. So when there's more volatility, we find that as an increased opportunity. So we expand our exposure to that. And the reason for that is that gamma is lower and the price of our flies is less, allowing us to put on a much wider butterfly. That means more profit potential and keeping our risk to reward approximately the same. So for the same amount of risk that we put on, we can put on bigger trades. So that's what we're looking for. Now, this isn't a huge difference from last week. Last week we were looking at 30, so we're increasing it to another 5, one more strike wide. So while that might not seem significant to you, over the course of hundreds of trades, that change in our exposure makes a huge difference. All right. So we've got that. Now it's time to take a look at the market. Whoa, boy, look at that. That's incredible. So typically what I do is I'm looking at directional bias and I'll just look at the Hull suite. I don't think there's any argument that we're in a bullish trend. So now we know 35 wide and we're going to do an out of the money call fly. The next step is to look at our market structure, see where the structural levels are. And we'll do that by zooming in here. We're right at the top of the market, so it's a fairly new volume profile and structural levels. So there's not going to be a lot that we can look at, but I'm just zooming in here. Just give me a second and go to a 5-minute chart. And I already have it marked up. We'll take away the volume profile, and you can see that it looks like we're coming to or near all-time highs. So and I will mark up the sessions by showing the morning session. That's typically where we'll take trades. And so we're looking for a pullback into this level here at 71.38 or 71.20. And so typically what's been happening over the past week is we've been getting nice little pullbacks right at the open and then just taking off. That's what's been happening over the past week or so or more. I don't know when that's going to stop, so I'd say go with it. Or we could pull back to the 71.20 level, and that's certainly possible. We'll be prepared for both. But when that event happens, and we'll talk about that a little bit more today with our discussion on gamma. When that event happens, that's when we'll put a trade out of the money, typically a out of the money butterfly, further away so that the debit is never more than 10% of the width of the fly. That gives us at a minimum a 1-to-9 risk to reward ratio. We might put it further out as much as 5% of the width. That would give us a 1-to-18 risk to reward ratio. So those are the type of trades that we're looking to put on. All right. So we got that all squared away. Our next step is to go to the presentation. PowerPoint. There we go. The GEX. By the end of this session, you'll know what positive and negative GEX actually mean in trader language, how to read a profile in 10 seconds, and where to park your fly, and the single late day setup that prints over and over, but only on the right kind of day. All right, we call that our own version of a gamma scalp. All right, so let's get to it. Let's go to slide number 2. Now, before we dig in, our goal every episode is exactly the same. And this is our goal as a company, the 0-dte.com or the flyonthewall.ai. It's all the same company. We focus on helping traders become consistently profitable, independent, and trade at a pro level. That's it. Every tool, every setup, every trade serves those 3 things. All right. That's our guiding principle. So what is it that we're covering today? Now here's the run of the show and why GEX matters in the first place, why dealers have no choice but to hedge, then the two and how the two regimes, friction and gravity versus slippery slope. That's the way I describe whether you're in positive or negative gamma. And we'll talk about that in a little bit more detail. What's the anatomy of the profile, the flip zones, the magnet that pulls from both sides, why 0DTE breaks the rules. That's important. A lot of people, when they're talking about gamma, they're not talking about it in terms of 0DTE. They're talking about it in longer dated options. 0DTE is a completely different story when you're starting to talk about gamma because everything is compressed into one day and it's exciting. It is exciting. That's why we do it. Then we pull up a live profile and walk through it together. We'll tie GEX to volume profile. That's an important thing. Let me describe GEX and the relationship between GEX and volume profile this way. The profile is the history of where the market has found value or no value. And so we can look back at that and see a record of it through the nodes and the deep wells and the crevices and all of that shape. The GEX I like to look at it like a swarm of bees, like honeybees. Now imagine that they're all swarming over it. That's the GEX. That's all of the dealers. They're hedging and doing their thing and going nuts. It's moving all over the place. And then when they leave, they're left with the honeycomb or the structure. And that's the volume profile. That's the way I like to look at it. All right. Let's see. We're going to pull up a live profile and walk through it together. We'll tie how the GEX ties to the volume profile, specifically the nodes, the node rims. When I say the node rims, the edges of nodes, a lot of people look at the POC of a node. And as a matter of fact, I made a very big point of it last week that the POC, the value area high and the value area low, they are myths. They have absolutely no place in your analysis of volume profile because they're totally arbitrary. So we're not going to be talking about that. That's all theater. And we'll look at two setups, trading the flip and the sandwich. The flip and the sandwich. What I'm really talking about is the end of day trade, the gamma scalp, and then how we deal with gamma flips, which a lot of people associate with zero gamma. And that late day scalp that most traders completely miss and really don't understand what actually sets it up. We'll talk about that as well. And then in closing, we'll have a little Q&A. Show usually takes about 60 minutes, so let's go. Let's see. There we go. It's all about dealers, right? Dealers simply don't have a choice in what they do. And I'm talking about dealers, market makers. A lot of people think that they're out to get them or whatever, but they have a job, and their job is really uniform. It's all about creating liquidity and keeping their books balanced, delta neutral. And so when the market's moving, that puts a lot of pressure on them to reel it in a bit. And when it's not moving, they need to be able to provide the kind of liquidity people need to make a market. So here's the foundation. Dealers wrote the options you and I are trading. They don't want directional risk, so they hedge constantly, every single tick. And it's not a choice, it's their job. 100% of that flow is forced. No opinion, no judgment, just math telling them how many futures to buy or sell right this very moment. That's their job. Like I said, creating liquidity. And that forced flow, it is the intraday tape. It's not an overlay. It's not a signal. It's the thing itself. Once you see that, you stop fighting the market and start reading what dealers have to do next and how that affects us as traders. A lot of people talk a great game about what the dealers are doing, but what does it actually mean for us? How do we actually position our trades based on what we see in the GEX? All right, let's go on to the next slide. Friction versus gravity, slippery slope. Okay. This is my own personal take on the GEX and what gamma actually is. But let me just say right what the technical definition of gamma is. And that is the change in value based on on price, or the sensitivity of the value of my option based on price. So as price moves, say, a point or 5 points or whatever it is, how much does the value of my option change? If it changes a lot, that means I have high gamma. If it changes a little, that means I have low gamma. Think about it like a profit curve on a butterfly. Sometimes it's really flat. That would be low gamma because the slope of that profit curve is low. Sometimes later in the day, the profit curve is almost filling up the entire butterfly and it's very steep. That would be high gamma. So that's super important. Where most tutorials, they lose you on this point. They'll say, when dealers are long gamma, vol is suppressed. Forget it. Here's what actually happens on your screen. Positive gamma, positive GEX days. That means that there's friction and gravity. The floor is like a carpet. Price tends to move. The ball slows down. Small overlapping candles. Pins mean reversion. Theta grinds. Files print. That's zombie land, and that's Goldilocks. Think of high gamma as gravity, and or compression or consolidation. When there's high gamma, dealers, they need to sell those rips and buy the dips. So they're compressing everything. They're moving everything in, and that tends to act like gravity, and it results in smaller candles, less movement. But it can be directional movement too. But directional towards where that gamma is, or that big GEX bar. Think of big bars, price tends to be attracted to it. All right, so that's basically what it is. Now, negative gamma is a totally different animal. It's almost the exact opposite. It's like the floor isn't a carpet anymore, it's ice. Price, that's a good way to put it. The ball rolls and keeps on rolling. Big candles, trending, breakouts, extend, chaos regime, event days, that sort of thing. You get towards negative gamma and things want to move. Right? So just imagine those two scenarios in your head, and that's what is meant by positive or negative gamma. And here's the tell you'll use every morning. Big green clusters breed small candles. Big red clusters breed big candles. Put that image in your head. The GEX tells you the size of the candles before they print, and that's the edge. And of course, in our fly on the wall, you'll see that we're showing gamma in the back of our butterflies. And this is a unique way of looking at gamma and then putting it in terms of your risk graph. And so on our application, that's exactly what you can do. You can create your position, and then you can see exactly where the GEX is relative to your position. We can also put the volume profile behind here as well. This is a lot like what you'd see on Thinkorswim, but I believe that our chart is actually even more functional. All right. So again, get that image in your head. Big green clusters of these gamma walls, if you want to call them. They breed small candles. Big red clusters breed big candles. Compression. Think compression and expansion. Those are the two terms that most people use. All right. And we in the right place? Yes. All right. So now we're looking at the anatomy of the flip zone, or the anatomy of the GEX. So this is basically what a GEX profile looks. Bars are stacked at each strike. So every bar is associated with a strike on your SPX. The green is essentially calls, the red is essentially puts. The way that these bars are calculated, they take each strike and they take the gamma and they multiply it by the open interest times 100. So you're essentially seeing the weightiness of gamma at that particular strike. The right side of zero, or in this case, the upside, is positive gamma. Magnet strikes, call walls. Left side, or the lower half, that's negative gamma. Those are the ice zones or the slippery areas. Put supports that eventually break. The biggest positive bar is your strongest magnet for the session, and the biggest negative bar is where it gets really slippery. And the gold bar, or the flip zone right in the middle, that's the crossover point. They call that the flip zone. But you got to be careful there when you're looking at a flip zone, because it could manifest itself in two ways. What we're looking here is something called net gamma. And now net gamma is basically taking the calls and the puts and then subtracting them from each other and then getting whatever's the difference. And so that flip zone could in fact be a low amount of gamma on both calls and puts, or it could be a huge bar on both sides where there's huge contention, but they cancel each other out. So for that reason, I like to switch back and forth between net gamma and the full picture of gamma. Let me show you what I'm talking about by bringing that up in the chart. So when we see the gamma back here, this is what we call net gamma. And when we click on calls and puts, it will show us both sides. So the net gamma is the difference right there. And then this is showing us both sides. So you can see where these little balls are showing us where zero gamma is. It's not really zero per se. As a matter of fact, there's much less gamma right here than here. But because of the net effect of it, it's giving us a much smaller difference. So it's closer to zero. So that would be considered a flip zone right there. All right, now I got to go back to the PowerPoint. All right, so let's talk a little bit about those flip zones. If there's one number you mark every morning, it is definitely this. The flip zone is where positive GEX turns into negative GEX. Above the flip, you have that carpet country or that compression. Brakes engaged, small candles, pins, fades work, files print. And below that flip, it's like ice, momentum. Momentum is on. Big candles, breakouts, fades, get overrun. Same symbol, same day, completely different rules depending on which side of that flip zone that you're on. And price crossing the flip isn't a level to fade. It's the regime changing. Your trade with the new regime, not against. You want to trade with that. You don't want to look at it as necessarily price going down or up. It's just a new character to the market. So think of it as trending versus consolidating too. That's another way to look at it. So it's just different rules, and you have to be cognizant of when it makes those changes. All right, let's go to the next slide. It's not price action where you're looking for patterns or anything like that. It's either in one of those zones or it's not. The other thing is that you got to be real careful when you're looking at gamma, and because most people that present gamma do it in a way that is static, and you don't see constant updates. And gamma can change on the fly. It can change very quickly, and so I would recommend having a live version of gamma that's updating constantly. Our gamma on our fly-on-the-wall application is updating every 5 to 15 seconds. So you're getting a good view of that swarm of bees and where they're working. All right. So slide number 8. So the magnet that pulls both ways. Here's the thing that trips up most every new trader. They see a big green bar on the GEX chart and ask, is that support or resistance? And the answer is that it's both. It depends on where price is. Price above the bar, it's a ceiling. The bar is pulling price down towards it. But price below that big bar, it's a floor. And the bar is pulling price up towards it. So that's a pretty significant look. So if you're on one side, it depends on what side of the bar that you're on. It acts like gravity. It's the same bar, same pull. It doesn't care what side of it that you're on. And late in the day, as expiry gets close, that pull gets stronger. That's where pins come from. Heavy open interest plus expiration equals price glued to that strike into the close. And why is that? Particularly on a 0 DTE day, the all the premium is coming out and the gamma is increasing as you get closer. It's also consolidating. So a lot of times you'll see midday, you'll see a lot of bars like green bars and red bars spread out. Then as you get further into the day, they start consolidating into one or two major bars. And so that's gamma increasing, that's premium decaying, and in a butterfly, I don't have a picture of a butterfly, but maybe I can bring it up into here and show you. Let's do that. So I can simulate going later into the day. I'll just make this a little wider so you can see that. And so as the day moves on, that's premium decaying, going up and up. Now notice that the steepness of that profit curve, that slope is literally gamma. That is the sensitivity to price. So price moving back and forth like this in a very steep curve is going to be higher gamma. And that's what's happening as you get closer and closer into expiration. And that's where you'll see these bars start consolidating around that. And that's really an opportunity for a late day trade. And that's what I was talking about earlier, doing a gamma scalp. You can use your butterfly and a gamma wall or a structural element and kind of sandwich price between them and have a really good opportunity for a quick profit because of the cost of these flies is diminishing, but the sensitivity to the price is increasing. So any little move at that day can really turn into a big return. I've had some trades later in the day where you set something like this up and maybe spend $80, $100 and turn into an $800, $1,200, $1,500 trade with just a very small move. But knowing when and how that's setting up and understanding gamma is really the secret. A lot of people think that you can do it at any time, but it works best. I know I'm getting ahead of myself because that's something we'll be talking about tomorrow or the next day. But gamma scalping works best in lower volatility. Gives you a wider opportunity, more time to do it than high volatility. High volatility is very difficult. High volatility is essentially associated with lower gamma, believe it or not, and low volatility is associated with higher gamma. That's because premium decays faster and these curves get taller. It's not the easiest concept to understand. And let's see, I need to go back to the presentation. All right. So I'll go into the next slide. So why is 0 DTE such a big deal when it comes to evaluating the GEX? The standard GEX models assume weekly or monthly expirations, where 0 DTE collapses all of that into a single session. And the distortions are absolutely real. There's concentration, all the gamma risk compressed into hours, not days. Hedge flows intensify as we get closer to 4 p.m. And so from a 0 DTE trader, most of our opportunity is getting in early in the day when gamma is low so that we can affect a position and position ourselves. And then as the day moves on and premium is decaying and gamma is, and that sensitivity to the price is going way up, we also have to change our disposition. We don't have as much time. The sensitivity to the price is increasing, but also the potential of our trade is also increasing. I like to say that it's wonderful if you can get into a trade later in the day, because that typically means that if you got into it earlier and you're still in that trade, you're making a lot of money. But the pressure of staying in that trade is also increasing. That's really important. There's also a charm bleed. Out of the money gamma drains super fast. The walls that you saw at 10 a.m. might be softer by 2 p.m. And the profit tent on your fly sharpens absolutely every minute. As I showed you how that premium curve grows, the steepness of those walls are also growing. And let me go back to that and show you like the difference between low volatility days and high volatility days. And then you get an appreciation for it. So here I showed you how it changes over the day. But watch what happens in low or very high volatility. See how everything flattens out? And it will stay like that going into near the end of the day. And which gives you a lot more potential, but it's harder to make money early on in the day, but it's easy to get into a trade because you can put on trades for cheaper and you can put them on much wider. And the interesting thing is that the wider the fly that you put on, the more this profit curve will be pronounced. In other words, it will be higher. And I'll show you a presentation on that probably later this week. So that's one of the reasons why we like going to wider flies, because they give us more opportunity, they grow faster, and there's more potential. And in high volatility, it allows us to put on even bigger ones. So like where in low volatility, we might be looking at a 25 or a 30 wide. In high volatility, we'll be looking at a 50 or 60 wide. And the difference between those two could be a total profit of, say, $2,000 versus $5,000 or $6,000. When you get to higher volatility, that kind of flattens out, and it remains like that until late in the day, until it finally comes in. But low volatility, look how it is already pre-packaged. This is with a VIX down around 11. Our VIX right now is at about 18 and change, so it's starting out like right here. So this is middle of the road. All right, let's go back to the presentation. So let's go to slide number 10. So reading today's actual profile. Where is the flip zone? Oh, we saw that. We're almost right on top of it, actually. Where's the tallest green bar? Where's the tallest red bar? That tallest green bar is the strongest magnet, and that tallest red bar is the slippery zone. So when you're watching price movement and you're mapping that to gamma, it'll give you an idea of how price is likely to behave wherever it is. So that's why you want both price and gamma watching them at the same time. And here's spot. We're right on a flip zone. So we're in between. Yeah, the gravity's up here and the slipperiness is down here. Friction, ice. But we're right on that edge. So let's take a look at where price is. See how that is manifesting itself. So yeah, we're taking off here. So that's interesting. We're right there. We don't have a strong affinity towards anything. We're actually leaning more towards negative gamma, which means that dealers are starting to lean into this. And so if we're near negative gamma and the price starts going up, they'll start buying into that, and you may see a runaway market. If we were more into the positive gamma side, into those big green bars, you wouldn't be seeing these big candles. It would act more like down here. All right, let's go back and let's go here. When GEX and volume profile agree. So GEX is going to tell you how dealers are behaving and whether they're pushing price or they're trying to pull it in. Are they hedging it or are they going with it? And so that's important just to give you an idea of how price is likely to behave. So that's what the GEX is mainly going to tell you, how price is going to behave. But volume profile is also doing the same thing. Although when we're at all-time highs like this, it's a little bit more difficult because there's no historic volume profile to lean on. But because of that, that also means there's very low liquidity. So we're moving higher into a very low liquidity area. So that tends to move us towards the negative gamma. And so price could run very quickly. Now, so that's basically what you're seeing. It's a kind of a special situation being at all-time highs, but because of that low liquidity, that's what you're seeing. You're more likely going into negative gamma. And a lot of people associate negative gamma with price going down, but not necessarily. It could also be price going up, and that's exactly what we're seeing right now. All right. So this is during low volatility times, and I would imagine with price going up, that volatility is going to start coming down. The VIX is going to drop. It's going to present an opportunity later in the day. See, trading the flip. I went ahead of myself. So trading the flip, and that's exactly where we're at right now, right? Step one, you want to mark it where it is in the morning. We already know where it is. We're virtually right at it. before the bell, know where the flip is, know how far spot is from it. In this particular case, we're just on top of it and we're starting to move above. Size by regime, if we're above the flip in positive GEX, you're in carpet country. So in other words, if the GEX, if the price starts moving up into those big green bars, you're going to start seeing some resistance to price continually moving up. So that's an interesting thing. But the bars themselves can change. So you got to be real careful when you're watching that. This just seems like a seminal moment when we're looking at this. But as you can see, prices moving into these larger positive gamma bars, it's definitely going to be attracted to this, which means that if it is, then the negative gamma is starting to reduce. That means that we should be hitting brakes as we go higher. But it looks like we're flipping here right now. Yeah, so if I go to trading view, you can see that we're getting some resistance here. We really started to take off. We were in negative gamma, and now we're moving more into that compressive zone here. James is asking, so today if there's no pullback, you never put on a trade? That's kind of like the size of it. I need a pullback into structure before we take a trade. But we're in a weird spot. We're right at the flip zone. Price could take off or it's just going to stop cold. And I don't know. This is one of those places where I don't know what's going to happen. And so I'm more likely to hang back for a little bit and wait for a decisive move that might come back into structure, basically just like I'm showing here. Yeah. This is definitely the toughest market to trade when you're breaking out and going into all-time highs. It's like going into territory where you have no maps, no idea of what you're going to expect. And that's where we're at right now. Interesting. Great time to do this presentation. All right, let's go back to it. Try to finish it up. I look at these different explanations here of trading the flip, and I didn't anticipate us being going to all-time highs and then being on a flip zone, which is really weird because you would think that you would be on one side or the other, but we're not. Don't fade a flip across. Wait for confirmation, and that's basically what I'm saying. And what confirmation is? Moving into a structure. So right now, there's no confirmation. We're just out there in nowhere land. There is no profile or market structure to find some kind of grounding. So I would say just hang on. This is a price could go anywhere. We could shoot to the moon or we could drop like a rock. And I think a lot of that is waiting on to see what's happening in a geo-macro sense too. So we're in a really weird place right now. So this is the concept of the gamma scalp that we can probably do later in the day when the profit has, let's see if I can do this. So later in the day when our profit curve kind of looks like this, we'll look at where spot is, right? And see if we can find a time when it's just above structure. In this particular case, it doesn't exist. But then you'll find that our butterflies will start getting cheaper and they will have a lot of the premium out of them. So you can get them really close to spot, maybe put them like right up next to them. And that's what we're really looking for. And these are the elements of a good gamma scalp from a 0DTE trader's point of view, is to try to, later in the day, these trades typically in low volatility will happen anywhere between 1:30 and 3. In high volatility, it's a much smaller window, usually from 3 to 4, and a little more difficult. But today is probably going to be a good opportunity for a gamma scalp later in the day. All right. So I'm going to go to the big head here and say that this has been a particularly interesting day to do this presentation. We can look at the volume profile. We can see our position of the GEX relative to that, but there's nothing like that. We're just in Yeah, the trading den is saying we're in no man's land. That's exactly right. So I look at this and I'm thinking, okay, how am I going to shape this presentation so it all makes sense? But we're in an area where it is actually no man's land, where we could take off and just off like a rocket, or we could just hang out here for a while, or we could drop. Anything can happen. And actually, the best case would be is if we dropped into structure, then at least you have some tradable events. But up here, it's, man, you're like up in an air balloon and there's a storm coming. You don't know which way it's going to blow you. That's where we're at. But in any event, we talk about gamma every day. It shapes all of our trades. And in most cases, when we have normal markets, I don't consider this necessarily normal. This is how would I term this? This is definitely an outlier market. It provides huge benefit in terms of understanding how price is likely to behave, whether or not there's going to be compression or expansion on one side or the other of a strike or area. And that helps us position our trades because if we can get a sufficiently low-cost trade, we'll have an idea of how price is likely to move and then how it's going to interact with structure. Today, I think it's totally up in the air. All right, Trading Den says, I can say with 100% certainty that the market will go up or down from here. Yeah, I agree with that 100%. Yeah, so if there's no pullback, what is the source of the data? I'm not sure I understand that question. What is the source of the data? The source of my data? I get all of my data from a company called Massive, formerly Polygon, and that's what drives our chart. But the source of my presentation data, that's from my experience. Anyways, that's the GEX. GEX, in a nutshell, is not going to tell you what direction price is going in. It is going to tell you what the nature of the market is and how dealers are positioning themselves and whether or not price above or below a particular strike or area is going to have more consolidating behavior or trending or expansion behavior. Small bars versus big bars. And your positioning on one side of what you're really looking for are from a decision-making point of view is the biggest bars that you can. When you get near big bars, those will typically give you a much better sense of likelihood of what's going to happen. Big green bars tend to be kind of gravity-driven, lots of friction. Smaller bars and red bars tend to be exactly the opposite. I call them icy or slippery and tend to move out and away quickly. And then the zero or flip zone is the in-between. And that's where we're at now. We're in a flip zone and all-time highs, and it's not something that you would normally see. Here's a question. How much better do you find the payouts using the out-of-the-money condors versus just buying out-of-the-money debit spreads? First of all, I don't use either out-of-the-money condors or out-of-the-money debit spreads. A out-of-the-money butterfly is a far better payoff and it allows you to control your risk much better. A condor, in essence, is like a butterfly, but you're capping the profit and you're creating a totally different payout, and they typically cost a lot more than the butterflies. Debit spreads, it depends on how far out you're going. If you're going much further out, then a butterfly starts losing its optionality. But overall, I much prefer for almost everything that we do in 0DTE is using the long butterfly, long call or long put butterfly. It provides better payout outside of the profit tent. Oh, that's what you meant? No problem. Yeah, once you start going further out, then the spread or even a single call or a put starts making more sense. But that's typically only the case in extreme markets, two sigma moves, that sort of thing. And most of the time we're somewhere between half a standard deviation to 1.5. That's our sweet spot. The butterfly by far is the most effective strategy to use as opposed to the condor or the vertical. Yeah, and I agree with that. That sometimes you can use the broken fly to try to reduce your risk. You just have to be careful about when you put them on, and if you start running through them, you could actually start losing money. But if you can fashion a broken fly so that you'll make money going into it, that's usually a better situation. All right. That's about all I have to say. Thank you all very much. If you like this presentation, give it a thumbs up. We might go over this again at a future date when we have a market that's more representative or normal, should I say. But the rest of this week should be really good. We're going to start talking about individual strategies and plays that we would normally do during the day with our 0DTE out of the money butterfly strategy. All right. Thank you all very much. Give it a thumbs up. Go down below, subscribe if you'd like to join our service. Yeah. Oh, by the way, the PowerPoint, I'm going to put the link in the description. So you'll be able to download it. All right, guys, have a great day, great week. Take care.